It's a new month here at Henssler Financial, and we found 3 important things to focus on in the market this month. Number 1, AI. The performance of the Magnificent Seven has been well documented. They collectively contributed nearly 70% of the S&P 500 return in 2023. However, it hasn't just been the big names. Common to all 7 of these stocks is a boom in investment in artificial intelligence that continues to drive the market. Crazy or not, AI continues to be the number 1 theme. Since ChatGPT was released in November of 2022, the 67 stocks related to AI and the S&P 500 have surged by an average of 45%, while the other 433 have only gained an average of 8%. Some of these gains have been driven by recent growth, but a lot of future growth continues to be baked in. For instance, NVIDIA, arguably the biggest beneficiary of AI, saw revenues grow 300% since the release of ChatGPT, but the stock is up over 500% over that period, with expectations for rapid growth well into 2025. We will continue to monitor if the AI theme leads in 2024 and if these companies can deliver on their sizable growth expectations. Number 2, inflation. Fears are reemerging that inflation expectations may become rooted above the Fed's 2% target. Core inflation remains stubbornly high at 3.9%, and headline inflation, while declining to 3.1%, missed expectations for a decline to 2.9%. This may change the calculus for the Fed into the middle of the year and affect market expectations for more accommodative policy. Last major tightening in financial conditions came in October and saw equity markets swoon while the 10-year yield rose to 5%. With real wage growth picking up in recent quarters at a roughly 2% pace, the question will remain if the Fed has done enough to tame inflation or if future hikes may be in the cards. Number 3, bank funding. On March 11th, the Federal Reserve will end the Bank Term Loan Funding Program. This was a program designed to ease some of the balance sheet liquidity strain on regional banks that began with the Silicon Valley Bank's collapse in March of last year. Effectively, it allowed banks to borrow against their government bonds' par value and not their depressed market value. While we did see a handful of other bank failures, this largely stemmed the tide of a bank run. The effect of an unwind of the program is yet to be seen, but the total value is roughly $170 billion that will have to find liquidity elsewhere. This also comes at a time when excess bank reserves continue to decline. Arguably, banks in the market will not feel the full effect of quantitative tightening until reserves become more scarce, and we are nearing that level. If bank funding in aggregate becomes more difficult, it could affect credit markets. We will be closely watching the banks in March for any signs of stress. And that's been your Market Minute for the month of March. Thanks for listening.